Appreciate it. So Mortgage 101. I think we've got everything in line here. So um, awesome. Well, thank you guys for being here. She said I'll tell you everything about mortgage. It probably won't fit into 2 hours, but pretty close on. I call it 101, just kind of the basics of programs and what we're looking at. We'll talk a little bit about kind of the agenda here in a second. They like me to kind of introduce myself. Michelle always does a great job of that. But JJ Astorquia, Bluebird Home Loans. Been doing this for 20 years now, 20 years at the end of 2024. So started January 1 of 05. Licensed in about 10 states now. There's a couple missing there, Florida and Utah. Born and raised in Idaho, and kind of made my way through the Northwest as far as going to school in Eugene, and then Portland and Seattle, and about 10 years total. And then Idaho kind of just draws you back, right? So it's been awesome helping tons and tons of families get into homes, refinance their mortgages, and a lot of repeat clients and a lot of great realtor partners. So that's about it on me. So I'm supposed to leave this up here for a few minutes. You guys read really fast, right? IREC pre-license course attendance policy. Basically, you can't leave halfway through when I give you a break and get 1 hour of CE. You got to stay here, the full time for the 2 full hours. But hopefully we'll make it interactive. Definitely make sure and ask questions. It's kind of the second half of that as well. So today's agenda, we're going to talk about the process, kind of what buyers go through when it comes to getting a mortgage. We'll talk about kind of how that goes hand in hand with what we call a pre-approval, getting them ready so you can actually take them out, put them in your car. I think you maybe drive separately a lot these days, but take them out, look at homes. We're going to look at mortgage products. So if you have questions specifically about types of home loans out there, we're going to hit, kind of high level on basically all of them from the residential side of things. And then communication best practices. And I put Q&A at the end, but it'll get really boring if you guys don't interact. So I'll probably force you to a little bit. I'll try and use the whiteboard a little bit to show you kind of some, real world examples of a few things. But Q&A is anytime you have a question, just raise your hand. All right. Disclaimer. This course will give you knowledge of the mortgage process and give you the ability to talk with future buyers with confidence. It will not make you an expert, and you should not act in a capacity that leads buyers to believe you are a lender. Kind of like me staying in my lane. I try not to act like a real estate agent, but they asked me to put this up here. Always refer to a licensed loan officer for proper counsel. All right, so the home buying process. One of the I guess things I always say to buyers is what we do is it's not rocket science, but there's a ton of detail in what we look at on the mortgage side of things. So basically we kind of broke it down. There's a few other things, of course, that are happening inside of maybe each one of these, but into 9 steps, right? So put down on the right-hand side kind of what your role is. So in step 1, we're examining their financial situation. Basically, from a realtor's perspective, encouraging buyers to have a professional examine their financial situation. So basically, what are we looking for, right? Getting them pre-approved is kind of the big step. Step 1 and 2, we get all their information, have conversations with them, and then take a look at all that information and get them pre-approved. This allows you guys to have the confidence to take them out and show them homes, right? Does anyone ever have a buyer that just wants to go look at homes and they haven't done this yet? All the time, right? It's okay. I mean, I think, that especially if you're a newer agent, the practice is good, driving around, seeing areas, seeing homes, what's for sale. I'm just staying in the know on what the market is offering. But I would just challenge you to make sure that you have a qualified buyer, because there's nothing worse than having them fall in love with something and then wanting to go get pre-approved and they can't, right? They can't buy maybe yet or ever, but yet is usually the hope. We'll make them homeowners in some way at some point. But it's good for you to know that before you're out there, because inevitably what happens, right? If they're not pre-approved, when do they usually need to get pre-approved? Saturday night, about 6 o'clock. Guess what? Lenders aren't just sitting by their phones waiting. We do answer calls on the weekend. We will help you get pre-approvals done, but it's way easier at 10 o'clock on a Tuesday to help them than it is to scramble and get you guys what you need to maybe make an offer on a Saturday evening, or evening or weekend typically is when that happens, when the fire drill happens, right? So step 2, getting pre-approved. We call step 3, dream up your dream home. Basically shopping, right? Getting them out there, looking at homes. We want them to know this is the American dream to get into a home. So dreaming up your dream home, you guys out there showing them properties, sending them listings. It's pretty easy for them to click and find things online as well. We try to make sure that they're not doing as much of that as they would be if they weren't pre-approved, right? So once they're pre-approved, fair game. Get out there, take a look at properties. Always on our end, we're edifying you as the realtor partner to make sure that they're working with someone that they trust, that someone that can actually help them to get to the finish line and become a homeowner. I think, there was something big that happened around August of last year for you guys. What was that? Big lawsuit, the settlement, right? NAR. I think that, there's a lot of positives that came out of that. I mean, I think it's definitely made your, conversations more upfront about, like, what am I worth? How much am I worth? Here's some actual documentation that we need to sign to have those things in place. But we're always a team, right? And I think, working with a lender that basically looks at it that way, that you and us are working together to make them homeowners. So step 4, finding the right real estate agent. It's the biggest transaction of their lives. It really is. I mean, I don't think we can, overplay that more than we really need to. It's a big deal for someone to buy a home. And do you think this is gray and this is gray for a reason? Well, 20 years of taking on that stress, right? It's a big deal not only for them, but for you and for us to help them, because there's a lot of emotion, right? Is there anybody ever have an emotional client, a buyer or seller, that this is a really big deal, right? So making sure that we have all the pieces in place for them to get to that heart of the transaction there in step 5, and that's making an offer on the home. So really for you to be writing that offer, putting that documentation together to send that over. And that's where we would actually be matching up that pre-approval letter with that offer. So I get the question a lot, like we get done with the pre-approval stage and they're like, well, I thought I was going to get a letter from you. Like if I go online, I can just print a letter and I have a pre-approval. Well, sure, we can give you a letter that you're pre-approved and give you your max. But the last thing we want you guys to do is take that letter and send it over with an offer. If they're pre-approved for 500 and you're offering 428, we don't necessarily want them to see our cards, right? It's a little bit of a poker game. So at least for us, and most lenders do this, we'll create that letter and make it match to the offer that you're sending. They just need to know that they're approved for what you're actually offering. If that escalates, if you go back and forth, there's counter offers and it comes in at 438 instead of 428, we'll update that letter, get the listing agent what they need so that they have that in their paperwork as well. So making an offer on the home there in step 5. Step 6, the key for the real estate agent and the lender to stay in high communication when you're submitting your home loan into underwriting at that point. So anybody have an idea of are there any lenders that talk to you about having a full underwrite done prior to you making an offer on a home? Yes, it can happen. Truly a full underwrite is not just the income documentation from the buyer, but at that point you're also underwriting the property, right? So the collateral on the property, meaning the appraisal, title work, those things that we need. We can't get a homeowner's insurance binder until we actually have a property address, right? So there's a lot of additional things that we're actually looking at when we do a full underwrite. For us, we can do a full underwrite up front. We typically don't unless it's a buyer that's like right on the edge, right? Maybe their income or their credit is kind of right, to a border, like a debt to income ratio that's just right on the edge of them really qualifying, or we have some funky income. Maybe they've got self-employment, or they've got some bonus income that they haven't received yet this year, but they did last year and the previous year. We want an underwriter to actually put their eyes on that. You can do a full underwrite prior to, but really you want to get at least that full pre-approval. We'll talk a little bit about the differences in a bit. So step 6. Step 7 is an inspection required by the lender? Anybody? We don't require an inspection on the property. You can, and we recommend, I mean, most of you probably do as well, right? That they get an inspection done on the property so that they know nuts and bolts what's going on with the house. Some people are really handy. I'm not one of them. I need to know as a buyer, what am I going to need to pay somebody else to do later on when the roof goes out, or I need a new water heater, or HVAC system goes out, right? Plumbing is not great, or whatever it is, right? So getting an inspection on the property. Do we ever get a copy of that inspection on the lending side? Typically not, especially if you guys do what I say, you write up that RE10, right? That inspection contingency correctly, in my opinion. And that's not saying we want you to fix item 1, 4, 8, 13, and 15 from the inspection, see attached, right? You actually write out exactly what those things are, because if we get that, then we say, well, you're referencing something that we need to know what those items are, right? Typically, we don't necessarily want to see that inspection, because there may be things on there that you're not asking the seller to do that we don't really need to know, right? You can kind of open up a can of worms a little bit if you send us something that says that the roof is about ready to fail, but you're not asking them to actually replace it. So I would keep that inspection to yourselves unless you're referencing that inspection in the RE10, and we need that. So the inspection is something that we recommend when we're doing a borrower consultation with our buyers, but we tell them it's not required. You need to work with your real estate agent to make sure that you're writing that into the contract if you want to make sure and have one. We're not in a time frame right now where we're seeing a lot of, at least I haven't seen a lot of inspections waived recently. Maybe on new construction if they're getting a warranty for a couple years with the home. Signing documents and getting into the house are kind of steps 8 and 9. What's the other big one that really comes up a lot that's probably, kind of in that step 6? Appraisal on the property. So probably should be its own like subsection of number 6. Like when we do a mortgage, we're going to need an appraisal on the property most of the time. Not always. I have a couple transactions right now where we have what are called property inspection waivers. Has anybody ever heard of that? What do you think that is? So when we run automated underwriting, which is basically taking all their information, property information, throwing it through the Fannie Mae and Freddie Mac automated underwriting systems, it can spit out and say, we don't need an appraisal. On our side, they call it a property inspection waiver. It's really an appraisal waiver. So if you ever hear that term or see PIW, we use a lot of acronyms, which we shouldn't. PIW, just ask if you don't know, but that just means that they're not having to do an appraisal on the property. Why would that be? Why would we say we don't need an appraisal? Cash, they're not getting a mortgage, so there wouldn't be anyone requiring an appraisal, right? Good point, yep. Loan to value, typically stronger buyers, typically. Truly, at least what we've been told, it's kind of this algorithm that's supposed to, we don't really know exactly what spits out an approval, truly. But the automated underwriting for Fannie Mae or Freddie Mac really needs to have some information or data about that property. So usually when we see them happen, it's like somebody just bought the house 2 years ago and they're reselling it, and there was an appraisal done on the property at that point, and there's still that appraisal or that information about that property in the system, if you will. It may be also that it's pretty darn close or matches to the assessed value. A lot of times those are getting closer now. It used to be where the assessed value was quite a bit lower than what the sales price is. We still have, some of that. But yes, loan to value, high credit, If their loan to value percentage is low, then we might get an appraisal waiver on the property. And then the buyer gets to choose. They can still have an appraisal done if they really want one. Why would a buyer want an appraisal done? Verify, right? The third party appraiser that's verifying that they're actually getting a good price on the home based on comparable sales that are out there. I've had some that say, oh, I think it might come in low, which they think is an opportunity to renegotiate that price down. Doesn't always work in their favor. We've had low appraisals where the seller just says, well, you can still buy it for the price that we agreed on, right? But that would be a reason why they may not want to use that waiver on the appraisal. And then the keys. I would say those keys don't look a lot like house keys, but that's the picture that we had. Any questions on kind of the overarching kind of 9 steps? Okay. You guys are going to have to ask questions, or we're going to have a lot of dead time at the end where I have to dance and things. So I kind of went over some of these. These are things that I feel, or as a lender, I feel like real estate agents should be able to describe to their home buyers kind of what an income and asset underwrite is. All documents collected up front, analyzed, and pre-underwritten. I say pre-underwritten because if you really don't have a true underwriter that can put their, I say, stamp of approval on there, their number that basically puts their name and credentials on that file, I call it a pre-underwrite. Home buyer education meeting. I feel like every buyer should be doing this with their lender. If you're working with the lender and your buyer's like, I don't really understand really what's going on, then I think there's a problem, right? And that's something that I got in the business, like I said, 2005 through 2010, 9, 10 were what we call the fast and easy era. And they didn't really need to have much more than a pulse, right? And a social security number, date of birth, and like we'll see at closing. There wasn't a lot of consultation going on then. I think, that was a big awakening for us that, hey, buyers would get to the end of a transaction and be like, that was fine, but I didn't really understand what was going on. So home buyer education meeting where we review credit, talk about the budget, not necessarily just what they're approved for, but there's things that they have to pay for in life that don't go into that equation as well, which we'll talk about. And then always talking about next steps. So if they're first-time home buyers, there's resources for them for home buyer education as well. Sometimes it's required. We'll go through that when we talk about Idaho housing and finance. And it's really kind of a professional strategy consultation. What programs may fit for them, what down payment options they have. Just because you have 20% down doesn't necessarily mean at the end we're going to have them put 20% down. We have buyers all the time that say, hey, I've saved all this money. I've got $30,000 to put down, right? Well, that may be equivalent to, 10% down if they're buying at $300,000, right? Well, it may be better off to use some of that to, one, for a rainy day fund and save it. Or a lot of times I'll have buyers that they feel like they want to put a bigger down payment down, but they still have credit card debt, or they have an auto loan that they could probably wipe out and it would be better for their overall budget. So just making sure that they're going through that, matching them with the right lender to fit their needs. So things there that. Okay, so documentation checklist. I get asked for this. I am going to send all these slides out to you. I'll get all your contact information from Michelle. She'll do all the IREX stuff, but I'll send out to you guys all the slides so you have them. Kind of an easy way to think of it is the number 2, right? So we need 2 pay stubs. Unless they get paid once a month, then we really only need 1. Or if they get paid every other week, we truly are supposed to get 30 days worth. So we might need a third. But basically 2 will get you there. 2 W-2s. If they are self-employed, we're going to want 2 of what? Tax returns. What's another reason why we would want tax returns? Is there other income on there, maybe from an investment property? Like if they have another home that they rent out and they show that on their tax returns, we can use that income to help qualify. So 2 W-2s, 2 tax returns. If they're straight W-2 and they don't have any other, properties or anything like that, we don't necessarily have to, and we don't get their tax returns. We try to make it as small a list as possible, and make it as easy for them as we can. Same thing on the assets. Again, the rule of two. So bank statements, retirement or investment statements. Sometimes those are quarterly. We can get one of those and that'll suffice. So just remember twos on that. Credit report. So during the process, we will run a credit report and we go over that with them. We don't necessarily just send it to them because that's really all their information's there. We're not going to email that sensitive information, but we review that with them. And then we'll ask for signed letters of explanation. So has anybody ever heard like, oh man, this lender's just asking me for signing all these letters of explanation? It's true. They're usually pretty darn simple. Like I had my credit report run by XYZ bank or credit union. It did not result in any additional, I didn't get an auto loan or something else that's not showing up on my credit report. Just explaining different things, address variations for the ladies that do change their name. If they get married, a lot of times just explaining, that was my maiden name versus my married name, making sure that you are the same person. You can have many, many name variations on a credit report. Any derogatory credit or any credit inquiries, I talked a little bit about that one. We do pull a full tri-merge hard credit pull. You guys have probably heard hard and soft credit pulls recently. There are lenders out there that really push the fact that they only do a soft credit pull. I totally get it. I mean, the hard credit pull will have a ding on your credit. There's reasons, kind of a couple of reasons why we pull a full credit report. One is that we can use that credit report for all running of automated underwriting. You can do that with most soft pulls now as well. In addition to that, it gives us a little bit more buy-in from our buyer. So it's kind of a selfish reason, but we want to know that they're committed to at least going through the process, right? And if there's the biggest one probably is cost. So costs have continued to go up. What the credit bureaus or the companies that pull the credit bureau information together caught on to was, we're going to do a soft pull because it's less expensive. And if we have a lot of fallout, right? Anybody know what a pull-through ratio is for a lender? Like when we get a lead to when we close a deal, what percentage do you think of leads actually fund? Anybody have a guess? 20 is really good. And that's kind of that high end of kind of where most lenders are these days. What's a lead is like another question. If we get a name and a phone number and an email address, we count that as a lead. If we just get, hey, John and Sally are going to call you, not really a lead, right? We don't have a way to proactively contact them. But yeah, about 15 to 18% right now is really good. So it's cost prohibitive, right? If we're pulling soft credit pulls and it's charging us for all those and we only close, 1 out of 5 at best, there's a lot of additional costs there. So some of those are just, behind the scenes reasons, but we do pull a full credit report. Other things we're going to need, photo ID. For property owners, we are going to ask for their mortgage statement if they have a mortgage. If it shows that they have their taxes and insurance escrowed in that mortgage statement, we wouldn't need anything more for that property. But if they aren't, then we'll ask them for their property tax statement, their insurance binder on that property. Why are we asking for all those things? All of it goes into a debt to income ratio, right? So we need to know that they can cover not only their new mortgage payment, but any other payments that they have out there. So we're getting any HOA statements, homeowners insurance, mortgage statements, and property taxes on any other properties they own. Renters, not always do we need a copy of their rental agreement. Most of the time we don't, but that is on there as kind of an other item. And business owners, so the answer is right on there, but what percentage of ownership will require us to get not only a K-1 for their business, but also their full business tax returns? 25%. So if they say, hey, I own a business, but I'm a 10% owner, all we're going to need from them, in addition to their personal tax returns, is going to be their K-1 from that business. Twos, just think of two. If people ask you, buyers ask you, what am I going to need when I go to get pre-approved? Start gathering two of everything, right? So when we get all this information, we go through what we call the Dream Home Budget Worksheet. So on the right-hand side, I've kind of outlined what is included and what is not included in the debt to income ratio. It's kind of probably the biggest one that I see is on the things that do not count. We're not counting, I didn't put it on there. I put, fixed expenses, but in that fixed expenses could be, what's probably one of the biggest costs for parents? We'll just give you a hint. School or daycare, right? Childcare in general. That does not go into their debt to income ratios. It kind of shocks people because that can be, for some people, as much as more than a car payment, definitely more than, or sometimes even pretty close to what their mortgage payment is, right? So that is something that does not count that I should add into that list on the right-hand side. So there's a lot of things that when we look at a debt to income ratio, we're basically looking at the credit report, what's on the credit report, and then anything that would be coming from like a divorce decree. So child support, alimony, and then their new mortgage payment. If they're holding on to their current house, we would keep that in that debt to income ratio as well. There's a lot of other things we pay for in life, right? Utilities, gas for the car, cell phone bills, not cheap anymore. What else isn't cheap? Netflix times how many ever you have, right? Question?
I know alimony is debt, but is it also counted as someone who's going to purchase a home as?
Good question. Yeah, really good question. So yeah, it can be on the income side if they're receiving alimony or child support. There is a stipulation on that for most loan programs. I would just think of they need to have been receiving that alimony for 6 months in order to count it. Why is that?
To make sure that the payer is actually paying.
Yeah. Yep, exactly. There's some people, unfortunately, that don't make those payments, right? So we need to see that they're actually receiving it. 6 months on alimony is usually what we need there. So if you're in a divorce situation and one of the husband or wife has stayed home and they haven't worked, they're going to go back to work, but they haven't yet. But they're like, well, I'm going to receive whatever the number is, $6,000 a month in alimony and child support. They maybe not be able to pay to qualify until we've seen that that's actually been on there for a bit, or they've been receiving it. Great question. Yeah, thanks for bringing that up. What else is on there? I had childcare. It's really kind of small on the side there. Insurance. Health insurance, pretty expensive. Dental, eye insurance. I kind of named the others. Car insurance, cell phone, internet. So the do's and don'ts list. This is one that I think you guys should have a copy of this. Maybe, we can even just give it to you. You can make your own, put your logo on it, whatever. Because you have buyers that do these things that they shouldn't, right? So I kind of call it, jokingly, you shouldn't really need this. You should use your head. This is kind of the use your head form. But at some point, somebody quit their job the week before we were closing and they didn't get the house, right? Because they didn't have the income anymore. And they were like, well, you didn't tell me. Okay, it's fair enough. I didn't tell you at that point. I thought you'd already, gone through and you'd already talked to my employer, and I knew that had already been done. So I thought I can get a jump start on this and go ahead and quit before we get the house, because that was the plan all along. They didn't tell us, right? Don't change your job. Salary changes. If something goes up, great. If they are getting a new job, that happens, right? You get them pre-approved, and then just a new job comes about, and they get a new job. We just need to know about that. Make sure that we look at it, make sure everything still works out on the debt to income ratio. Don't make any large purchases. Has anybody ever gotten stung on this one? I'll throw RC Willie under the bus because they're really good at this, because they're really excited about getting into their house. They're going to get a new couch. They didn't have a fridge. Maybe it was new construction. They didn't have a fridge, or washer dryer was taken out by the previous owners. So they go, it's 2 weeks before closing. They want to have all that stuff when they get in there day one, right? Where am I going to put all my food? They go, RC Willie or whoever it is says, hey, you're spending $5,000 in here today. If you sign up for a card, you can save, $300. I mean, I would probably do it, $300, $500, 10% sometimes. Well, we coach them, and you should too, to make sure you do that after we get into the house, right? Most of the time, if they call and they're not financing it, or they pay it off quickly, or their debt to income ratio is fine, then they may be able to do it. So we can just have, a lot of communication, a lot of talk about it. Don't make any large deposits. Had one, it's probably been 2+ years ago now. Hey, we've got some cash that we have in our freezer. And I was like, in your freezer? I thought they were joking. No, yeah, that's where we keep it. Okay. In your safe, maybe. We call it mattress money, right? Stuffed under your mattress. You have a bunch of cash. A lot of people do this these days. They don't trust the banks fully. They want to keep, a little bit of cash. Well, if they're depositing that cash into their checking account, we can't source where that came from. So that's a large deposit that wouldn't be able to be used. Even if I've had this happen. Oh, I took $2,000 out yesterday in cash, and then I put it back in today in cash. We don't know that it's the same cash, right? I believe them, but they could have spent that $2,000 and gotten $2,000 from a source that they shouldn't have. If it's from a family member and it's a gift, totally acceptable. We can use a gift letter, document that, show that. But if they have any large deposits that are non-payroll, and people ask me what's large, really probably about 50% of what they make. So if they have a payroll monthly of $5,000 a month, if they have a deposit that's more than $2,500, we'll probably ask even if it's like a $500 deposit, to be honest. So keeping everything above board on where they're getting their cash. Don't apply for any new credit cards. Don't close any credit card accounts out. If you pay it down and then close it, what happens? You lose that credit history, right? So there's a pie. This is one thing that I don't think I have a slide on this. If I do, I'm getting ahead of myself. But this is usually something that people ask, like, does anybody know, or have you seen the kind of the credit pie? So 30%, I'll just kind of highlight a few things. The 30% of your credit scores is basically your revolving credit. When I say revolving, what does that mean? Credit cards, right? Credit cards. So in this 30%, let's say that we have one credit card and it has a limit of $10,000, and you owe, or the balance is $9,000. Pretty easy math on the utilization rate, right? They're using 90% of what they can borrow. 90%, not good. Some call that what? If it was 100, maxed out, right? Like you've used up all the credit you can. That's going to negatively affect your scores in this pretty heavily, right? A little bit of a game though. Let's say you had 3 cards and they were all $10,000 on the limits. You still had $9,000 total, but you had $3,000 on each. Now you're at 30% on each. That's going to be good, right? Kind of counterintuitive. Well, I owe the same amount of money, but you've spread it across 3 cards and you're at 30% on each. Does anybody know the ideal kind of utilization rate for credit scoring? Right around 10, or I've heard 8. I don't know why, but Um,
So does it skew the numbers? Let's say you had your same example there. They had 3 open lines of credit, all 10,000. They didn't use 2 of them. It was a 0 balance, and one of them was maxed. Would that change the ratios versus if it was spread equally?
yeah, it would. So you want to spread them equally. Typically, they don't want to do that because they have one at 28% that they don't want to use at all. And then the next one's at 20%. And the third one was a zero transfer, right? Oh, I can transfer for 6 months and not pay any interest. So they load that one heavily. And then we pull their credit and it's really pretty low because they're not mixed. So yes, but the other thing where I was getting at this was closing out a credit card, right? So another section here is the history. So let's say that, they've had these 3 cards for a long time. This one they've had since, 2010, and they pay it off to 0. And they're like, I've just been horrible always. Every time I keep it, I just charge it back up. So I'm going to cut up the card and I'm going to call them and tell them to close it out. We'll cut up the card. Great. So you don't have the ability to use it. Don't use it online. You still have it. It's traced out there somewhere, right? But if they close it out altogether, then now this 30% is just based on 2 cards versus 3, and that history goes away, right? So just some things that also why we do a credit consultation. I mean, we're not credit repair experts, but we've been doing this a long time, and your lender should have at least some pointers for folks on what they should be doing on their credit to maximize that.
What percentage is history for your credit score?
What, I'm sorry?
What percentage is the history for your credit
I think it's 30 here as well. Yeah. And the question for the recording is, what percentage of the history is history on the credit? I think it's 30 if I remember right. This is the one I talk about the most.
Do you also take into consideration, everybody uses debit cards these days, they're all Visa, but or MasterCard or whatever, but a lot of them have overdraft privileges to a certain limit. Is that counted at all in the credit?
No, unless, if the debit card is being reported in some way by that bank to the credit bureaus, they typically are not reporting a debit card. So then it wouldn't be affecting their scores. Yeah.
The credit line and credit card.
Like a line of credit versus an actual credit card. Yeah. So that would be, yes. It depends. Like if it's a home equity line of credit on the house,
No, just not credit, on a checking account.
I don't know on like a line of credit tied to your checking account. I guess if you're utilizing it and they're reporting it, I don't see a lot of those like reporting. I have one that I haven't used in, 20 years with my bank.
Does that count as the credit history?
I don't think that mine would even show up in there. Yeah, because it's at a 0 balance. It's not adding into this at all. If they're utilizing a portion of it, then they're probably reporting it to the bureaus, yes. And then it would fall into there. Good questions. We could probably talk about credit for a couple hours, so we'll table that for a second. What else on here? So that was on the don'ts list. On the do's list, so on the green side, the good side, keep good file copies of everything. Set additional money aside. Stay current. Don't start missing payments after we pulled your credit. Continue to use your credit as normal, unless normal is maxing it out every single month, right? But typically, we're a snapshot in time on a credit report. It's good for 120 days. So I get that question a lot on pre-approvals, like, well, how long is my pre-approval good for? Well, technically, at the 120-day mark, we would need a new credit report. We may need some additional documentation. If you get 2-3 months down the line, we'd probably want some updated pay stubs, W-2s, if it just went over calendar year like we just had. Keep your credit card balances below 30. So that 50% mark and above, not good. 50 to 30, a little better. 30% down to 10, and then 10 is kind of that, right where you want it, a little under 10%. Using credit, paying it off every month. Sometimes it's a little bit of a just timing game, right? Well, I pay that. I hear this all the time. I pay that one off every month. Well, it's $6,000 and the limit's 8. So when we pulled it, it could be having a negative effect on your score. we want to time that correctly or do what's called a rapid rescore on that, meaning we get that information that you've paid it down and we give that to the company that runs the credit and we have them actually rescore it based on that new balance. Any questions on the do's and don'ts? Is that helpful for you guys? Don't go to RC Willie.
I've also had clients who were close to paying off the car,
Yeah,
and the next payment was going to happen during the process of purchasing the house.
sure.
And so the lender said, bring the payment to close, showing me that it's got a stamp on it and everything, and I will put it in the mail for you. So I mean, there have been lots of those little things to help keep people from having a hit on their credit report. It would close the loan.
Yeah, closing out like an installment loan, there's that history is still going to be there. It's not going to be so. I guess just to rephrase the question, paying off debts at closing potentially, yes. I mean, we do that all the time where maybe their debt to income ratio is just a little bit too high, and we need to show that they've paid off their auto loan that was $350 a month, right, to get their debt to income ratios down. We don't necessarily need to do that. They might be selling a house and then buying a new one. And in the meantime, I have one of these that's closing next week. We're paying off their camper and their auto loan with their proceeds, and they're bringing the rest in for their house. Well, that brought their debt to income ratios way down. So we show that proof through closing that it's being paid. Yeah.
Yeah, they usually cut the checks right there.
Yep. If we need to show, I mean, if it's they'll cut the check and give it to the buyer,
Yeah.
and then they can take it and mail it. So yeah, we have to be on top of our game at the end to make sure we get an updated statement from them, because they're like, well, it's not, 8,322, it's 8,299 now because we made one payment and that's the amount that went towards interest or principal. So yes, we're always getting those updated and getting them paid off. A lot on refinances will do that, or we're doing the refinance in order to consolidate debt. Well, in order to actually get the approval on the loan, we need to show that debt's paid, and it's like chicken and egg, right? Like, well, we're not going to pay it until we have the money from the refinance. So it all happens at closing, and we can do that. So yes, they're cutting those checks because we don't want to give them the money and then them not pay the debt off, right? So yeah, good questions for sure. Then head to RC Willie, yeah, charge it back up, the American way, I guess, right? So pre-approvals come down to a couple things. We'll go about 10 or so minutes more, and then we'll take a break. So we talked about debt to income ratio, credit report. Those are really the two things. Again, it's kind of rule of two. Credit report, so the credit scores, a lot of detail behind that. And the second thing is their debt to income ratio. I need to update these because these are price points that we don't find a lot in our valley anymore. But just to kind of show you, what we're looking at, and this will play into the next screen. So $250,000 purchase on the left with 20% down. 6.25%. We're a little higher than that at this point, kind of higher sixes, lower sevens. Payment at $1,410 a month. Down payment plus all the closing costs. It shows you that they're going to need about a little less than $60,000. So that's one thing that we've been asked quite a bit, and we'll probably try to put actually a matrix together. But if you work with a lender, you should have an understanding, because a lot of buyers think, I'm going to bring in 20% down. And they do the math and they think that's the number, right? Well, there's costs associated with closing the loan that are going to be added on as well. So in this example, I mean, it was almost another $10,000, right? Closing costs, discount points for the rate, and prepaid items. What are prepaid items?
My insurance, prepaid, HOA if necessary.
Yeah, so prepaid items really boil down to prepaying your 1 year of insurance up front, some prepaid interest. So when we close on a mortgage and we close on the 15th of the month, they're going to pay the rest of the month's interest at closing, right? Because when we pay our mortgage payment, we pay in arrears, right? So if you make your mortgage payment on March 1, you're paying for the interest for the month of February. Especially for first-time home buyers, it's kind of a new concept to them. When they pay on February 1, they are paying for the month of February, typically, right? Unless their landlord lets them get behind. You're really prepaying on your rent, where you're kind of paying in arrears, you are paying in arrears on your interest. So at closing, we have interest days that get added on to the closing numbers, because then your mortgage payment, if it's on the 15th, wouldn't be due on the 1st. It would be due 45 days later on the, use February 15th as an example. Not March 1, but April 1 would be their first payment. So prepaid interest, and we also set up the escrow account for their taxes and insurance. So we're prepaying into that escrow account a couple months of taxes and a couple months of insurance, typically kind of 2 and 2 there, depending on the time of year. That's the way it shakes out when you look at a closing statement. So when you add all that up, it adds up, quite a bit more, right? So you got to make sure your buyers are understanding that they're going to need a little more than just their down payment. On the right-hand side, the 350 column, can't really remember exactly why I used 42%, but I think it's due to the next page. So we're showing the total cash to close here. And then this is where, during our consultation, we'll do things like we just talked about, right? Maybe there's some debts that we need to pay off. So when we look at this bottom line on a debt to income ratio, what's the number that you guys should probably have in your head if they're asking you? What does my debt to income ratio need to be? Anybody know that?
Used to be 36%.
Yeah, when our homes were quite a bit less, right? 43% is typically what is considered a debt to income ratio that you're going to get an approval on. Not always. I would say everything in the mortgage business is going to come with an asterisk. In here, it's not going to be a hard, fast rule. You might have somebody that has a 40% debt to income ratio, but their credit's, in the tank, and we can't get them approved, right? But most of the time, if you have a debt to income ratio around 43% or below, it's going to get approved. Honestly, on a conventional loan and FHA, maybe even a little higher, maybe up to as high as 50%. And that 50% is on what? Anybody know? Gross or net income? They make, I'll use easy math, $60,000 a year, so it's $5,000 a month. But Uncle Sam takes some out of there, right? And they have some medical and medical benefits and things they pay out of their check. In the lending world, we use their gross income. So 50% of your gross income, pretty darn high, right? That you can get approved for. So a lot of times when, we're having this conversation back, a few screens about budget, what's your comfort level for a mortgage payment might be lower, probably is, hopefully, than what they can get approved for. I talked about 2005 through 9. It was like, well, what's the max I can get approved for? Because my house is going to double in value like that. It didn't, right? So we try not to get people in trouble by getting them over their head on their mortgage payment plus all their other debts. So one of the things that we look at is, should we pay off debts, right? So in this column, with all the debts, we looked at, actually paying some off in this second column to get their debt to income ratio down to 48.66, where they could get an approval, right? Does it always make sense to pay off debt and take a bigger mortgage? I don't love the idea of having rolling in an auto loan. Like we have proceeds and then we pay off the auto loan unless they really need it. And it's really kind of more of a budget focus than overall financials, because rolling a auto loan in for 30-year mortgage, they're probably going to get another auto loan at some point, right? Now you don't think you have two, but you kind of have one in your mortgage payment and you got another one. So I don't always love rolling in an auto payment unless you just have to in order to qualify, or they really are just like, hey, we need a certain monthly mortgage or an overall monthly budget to make sense, right? So just a couple examples there, what we're looking at to potentially pay things off to qualify. Credit card debt, get that stuff out of there as quickly as possible. Especially these days, credit cards the rates on them are really high, right? Yeah, it can be as high. I think I saw one the other day over 30 for someone. Yeah, if your credit score's not very good and you get a credit card,
I don't think it matters on the score anymore.
it's just crazy.
An 8.7 credit score,
Yeah,
it was still at
30%. Getting those credit cards paid off. It's amazing how often I'll have people that have, oh, we have $20,000 in the bank and we have $8,000 in credit card debt. And I'm like, that paid off, right? Yes, typically we're going to need some money, but we'll talk about down payment assistance and some other ways to help them out there. Yeah.
I have a gal, she's been divorced about 2 years, and she's living with family members.
Okay.
So she's not paying a mortgage, she's not paying rent.
Yep.
Excellent credit, healthy down payment, job. Does that affect them if they haven't been paying a mortgage or rent or anything?
So the question was, does it affect them if they're not paying a mortgage payment?
Or
Like,
if you don't pre-approve, like, well, hey, you haven't paid rent, you have to have a mortgage.
no, I mean, we definitely I've had buyers that all of a sudden didn't use any credit at all. Like they don't have a mortgage and they're fed up with their credit card. So they just stopped using them altogether. And they have like over the course of even like 1 year, their scores can go from 800 to 0. They just don't have a score. So they need to make sure she's using credit
Right.
to keep that. It's
Yeah,
kind of a
she
game,
is.
right?
She is. She's
Yep.
just no mortgage, no.
No mortgage is fine. I mean, just like a first-time home buyer, they don't have a mortgage. Yeah. And rent. I mean, I saw some. I don't know. It was a stat. Rent's spendy, and I heard that there's like 40% of landlords now are actually reporting to the credit bureaus. In practice, I don't see that. I don't see a lot of rent that's getting reported to the credit bureaus, but I feel like it should be. I mean, it is a big number.
Well,
And
especially
it's-
if they're showing that they're paying, 16, 17 a month faithfully, they've done it for 3 years.
Totally.
Always on time. And
Yep. It can really help their scores if that is being reported. It can go the other way as well, right?
Oh, yeah.
Credit reporting is good if you're doing the things you should be doing, but yeah, if things are getting reported negatively, it can really bring the scores down fast. Yeah, good questions. All right. Does anybody know what this is? I've got it written on there somewhere. We got a seller. They're going to sell a house and then they're going to buy a new house, right? Well, you guys will want to become very familiar, if you aren't already, with all the different title companies. Fidelity has one. Any of the title companies, they have a net sheet calculator on their websites. I would utilize those. I'm going to show you a real quick calculation that gets really pretty darn close here in a second. But this allows you on most of their sites to put your information on there, be able to send something over that looks, professional. Couple of things that I would caution you on. Number one is their mortgage. You'll need to ask them, what is your balance on your mortgage? Unless they've already had their credit report pulled, and then you can ask us. We can tell you they have this much of a balance on their credit report. Typically, you're just going to be asking them when they're selling the house. They don't know, typically. Like if I asked you guys to guess yours and write it down and then go home and look, I would almost bet that about 90% of you would have a number that's smaller that you wrote down than what it actually is when you look at it. And the other reason that it's actually more is when you do a payoff, what I just talked about a second ago, we pay interest in arrears on our mortgages, right? So if you truly do owe, your principal balance is $315,000, is your payoff going to be $315,000? It's going to be one additional payment of interest for another 30 days on top of that, right? Mortgage payments are small now, or they're pretty big? Pretty big, right? Mortgage payments. I mean, we see them all the time, $2,000, $3,000, $4,000, $5,000, $6,000 a month, right? Well, that interest could be as much as at least a few $1,000s more, and it could change things, right? Maybe not too much, but especially if they're not netting a really big number out of the sale of their house and they need every extra $1,000, you need to make sure you're probably padding that mortgage balance in that net sheet calculation a little bit.
They can call the mortgage company and ask them what the payoff would be as a certain date, and they'll give them a pretty good number.
Yep, they can call. Most you can actually just go in right on their website and say, I want to pay it off on this date, and it'll calculate it as well. But yeah, have them do that. It's a good exercise for them too, because it's amazing how often they say, oh, we owe 400 and it's like 415. That's a big difference, right? Oh yeah, I was just ballparking. Well, when they see a number on the bottom, they get real excited about how much they're going to net, and they get to closing and you're like, well, you said your payoff was $15,000 less. they still are bummed, even though it was their error, right? So make sure you're doing these correctly if and when you're doing them. Is there a quick way to do it? Yeah, I'm a math guy, so I kind of calculated. Of course, that second line is everything has always been negotiable. Sorry, it's not just negotiable now. But if you use 7%, so sales price times 93% of that, or minus 7%, and then subtract off their mortgage payoff, always ask them, do you have one mortgage or do you have another one? Oh yeah, we forgot about that line of credit that I have $20,000 on. You get to closing and they're like, oh, they're closing that out? It's like, yeah, well, it's tied to that house, right? In their mind, they're like, oh, it just rolls over to my other house and I have that line of credit. No, they're paying it off. So quick calculation, sales price, 93%, 1% on title fees at a lower price point may not be quite enough. I used to use 1.5, but our price points have gotten bigger and bigger. You're probably not paying $8,000 in title fees on an $800,000 loan, but maybe half that. So if you use 1%, for most of these, it's going to be pretty close. So 93%, subtract off their mortgage balance, plus maybe a little interest, and that'll give you your net sheet. That's what I do, and it's usually pretty darn close within, a few $1,000s of what they end up netting. If all the garbage in, garbage out, right? If all the inputs are accurate.
Well, and Fidelity has an app, and you can just go in and do it, which is great for the weekend.
Yep. Yeah, the net sheet app.
And then, yeah, they'll give you
Perfect.
a sheet.
Yep. Yeah, you just do it right on your phone, right? You can plug all that information in. You're on the phone with them and you're doing it, and you can email it to them right from there. Yeah. So net sheet examples. I'll send you guys this little spreadsheet so you can just use it and plug it in. Disclaimer, might not be exactly right if you get bad information. Or you've talked to them about selling their house and they're going to offer 2.5% to you and 2.5% to the other side. Well, change the numbers, right? Then it's 5 and 1. Right? Hopefully not 0 for the other side. Just a little plug for making sure you take care of the buyer's agent. All right, I nailed it right on 1 hour. We'll go over programs in the second half, but let's just come back at, 5 after. Programs. So lots of options out there for residential financing. I do have a bubble on there that says commercial. There's going to be commercial lending options out there. We're not going to talk about those today. We will hit on basically kind of everything else on the screen, just at the high level. One plug too, I've got a colleague, Grant Porter, who has a class called Out of the Box Lending Solutions. So I'll answer any questions you have on kind of portfolio or things that are kind of non-conventional, if you will, today. But he has a full 2-hour class just on those. So if you're interested or need some additional CEs, I guess I didn't ask everybody, is everybody just cramming in their CEs before the end? They've got one of those, 2 of those, so a few. The rest of you, thanks for picking this class. For you that just had to have it, I'm glad you're here too. But let's go through kind of what the high level, what programs, who needs what program. So conventional, anybody heard the terms Fannie Mae and Freddie Mac? I think I probably used those already. So they're the at least right now, you're probably hearing a lot of conversation about making them private again. They were brought into conservatorship by the federal government back in, exactly when, but basically in the meltdown kind of 2010 timeframe. And they've been part of kind of quasi-government, but under the conservatorship of the government since then. So it's been quite a few years. They're talking about trying to bring them back out, make them private companies again. Usually better FICO scores, some down payment needed. Our max loan amount now for a conforming loan all the way to $806,500. So to date myself, I think it was like $350 when I first got in the business. Then it was about $417 for a long time. So for any of you that have been in the business for a long time, $417 was like a decade. And now basically every year it's been ratcheting up. What is a conforming loan? A conventional loan, when you hear that term conforming, that just means that Fannie Mae or Freddie Mac will buy that loan. right? Anything above that is considered what's called a jumbo loan. Government loans, so FHA, VA, rural development, also called USDA, RD, rural development. Usually lower FICO scores, not always. You can have higher FICO scores and lower down payment options. What does FICO mean? I'm using that term a lot. It's kind of like Kleenex for facial tissue. FICO is kind of like your credit score. It is actually one of the 3 models. Credit bureaus is called a FICO score. So when I use FICO, it just means your credit scores. Jumbo, talked a little bit about this already. Anything over a conforming loan limit, so $806,500. Not always. So again, that asterisk, right? Usually you're going to want 20% down on a jumbo loan. There are options out there for less. We have Idaho Housing and Finance Association, IHFA. You might hear that acronym. Offers down payment assistance, lower credit scores potentially that don't hit your rate as much as just an FHA loan or a conventional mortgage or VA. They have income limits, and this is not always for first-time homebuyers, but that's kind of what people think of. Idaho Housing's for first-time homebuyers, low down payment options. There are construction loans out there. So if you're buying a house and you need funds to build that house, and the builder's not going to build that house and then just sell it to you. I mean, that's what we have with like our production builders. It is new construction, but you're not getting a construction loan as a buyer. What I'm talking about here is the buyer actually getting their own construction loan. You'll probably hear terms like one-time close and two-time close. Kind of self-explanatory. You're closing once versus twice. There's benefits of both. We'll get into a little bit of that. There are options for conventional, jumbo, government, construction loans. Reverse mortgages. Anybody heard of a reverse mortgage? So 62 and above, you can get a reverse mortgage. Also, another term that you might hear is HECM, HECM. Anybody know what that stands for? Conversion mortgage, home equity conversion mortgage. I would actually use that term, become familiar with that term. Does anybody have a negative connotation when they hear the word reverse mortgage? They're really it's a great loan product. It has in the past gotten a bad name. So kind of staying away from using the word reverse mortgage, I think is good. If you use HECM, or I would use home equity conversion mortgage, people are like, what is that? Kind of self-explanatory. You're using your home equity and not having a mortgage payment. So you're using your equity in the house.
So can you walk us through that a little bit, or at least me? I don't understand.
Yeah. So reverse mortgage, if you're 62 and over, they basically use an actuarial table to tell you how much of a loan you could get. Right now, you're probably getting max. If you're 62, you're probably getting a max of about 25 to 30% debt or loan to value. So if you're buying $1 million home, you could potentially get a $300,000 reverse mortgage or HECM and not actually have a mortgage payment. So you don't actually have a mortgage payment because of the amount of equity you have in the house and your age. As you get older, if you're 70 or 80, you might be able to get more of the equity out in that sort of a mortgage because the actuarial table is saying, unfortunately, you're not going to live as long as a 62-year-old, right? It accrues interest and the balance grows over time, but you don't actually have a mortgage payment. There's some different, we'll go over a few little things on that, but there's another colleague of mine, Tyler Porter, has a 2-hour class just on reverse mortgages. So definitely become familiar with those. Portfolio. What does the term portfolio mean?
Generally means the bank's going to hold it in their portfolio, or a private lender is going to hold it as their investment.
Exactly. Yeah. The loan is not going to be sold. Typically, when you hear like Fannie Mae and Freddie Mac or even these jumbo lenders, will do the mortgage and then it can be sold to a different investor, right? A portfolio loan is they're kind of putting their own underwriting guidelines together, and they're saying, okay, we're going to lend you our own money and keep that loan, what I call in-house, right? Or they keep that on their books. Things like bridge loans, bank statement loans, specialty doctor programs, debt service coverage ratio for an investment property. Those last two there are why I say there's two full 2-hour classes on those. But let's go through a few of these. So typical characteristics on a conventional mortgage. The key word here is typical. These are not set in stone. We always want to be able to give you exact solid answers, but it's not always the case. Typically 680 credit or above. I would even almost say probably closer to 700 these days. 5% down or more. You can do 3% down on a conventional mortgage. Private mortgage insurance for loans less than 20% down. So PMI, anyone heard the acronym PMI? So private mortgage insurance. That means the insurance on the loan, the mortgage insurance on the loan is coming from private companies. There's about 5 or 6 that are kind of the big names. MGIC is one, Radian is another, blanking, but those are a couple of them. So you're getting the insurance on the loan. What is it insuring, you guys?
Insuring the bank for the loss.
Exactly. So we're looking at, if you have less than 20% down, you have less skin in the game. And as a lender or the bank, to use the bank, in quotes, wants some assurance that if there's a default on that mortgage, that they have some help with that. So you're getting insurance, and the buyer has the privilege of paying for that. On a conventional loan, you're typically paying for that on a monthly basis. It's part of your mortgage payment. I mean, if they knew who the companies were, they could, but yeah, that's typically, we just run it through our system, and not always do you choose the exact one that's the lowest payment, but most of the time it's just based on what that payment's going to be.
And the mortgage insurance doesn't go away.
So on a conventional loan, the question was, does the mortgage insurance go away? Is that what you asked? Yes. So on a conventional mortgage, it does go away. By law, it has to be dropped off at what percentage? It's actually 78%. So 20 is kind of the rule of thumb, right? You need 20% down to not have it. If you're paying your mortgage down and you have mortgage insurance on there, when it hits 78, it automatically has to drop off. The lender has to drop it off. You can also petition to have it off earlier than that if you feel like the property is appreciated, in addition to making your payments.
But not on the government mortgage, right?
FHA we'll get to in just one second. Yep. So on conventional mortgages, it will fall off there eventually. If you've got 3 or 5% down on a conventional mortgage, I would not, convey to them that it's going to fall off quickly, right? Yes, we hope that we continue to see appreciation of homes. It's kind of the what they're, the pundits are saying, maybe 3 to 5% this year, kind of what it's been the last couple of years. Still pretty good, but not a big jump in 1 year to where you'd see that mortgage insurance fall off. I would also say that you're going to have it on there for at least 1 year. So even if you come in and make a big principal reduction payment, you're probably going to have that mortgage insurance for a year. I think one of the big misnomers here, though, is that mortgage insurance is really bad. Did your parents or grandparents say, oh yeah, don't ever buy a home until you have 20% down, because you don't want mortgage insurance? For most buyers, do you want a house? You're probably going to need to buy before you get to 20% down, because at least over the last 20 years, probably really history of real estate, but last 20 years, other than that small blip, right? Almost 20 years past that now. Appreciation of homes, like if you're trying to save to get to 20% down, it's going to outpace you, right? You probably need to get in earlier, and then hopefully be able to take advantage of some of that appreciation of a home. So mortgage insurance is not a bad thing. You also have varying rates on your mortgage insurance. We call it the mortgage insurance factor, but it's basically a percentage, right? Based on your down payment and your credit scores as well. So if you have really good credit, say you have an 800 credit score, somebody said 800 plus, and you're putting 10% down, your mortgage insurance really isn't going to be very much. If you have a 680 credit score, it might be quite a bit. And that's where we'll shift and look at potentially FHA. So when I say 680 credit scores or below, it may be as high as 700. If you're putting 3% down on a conventional mortgage with 680 credit score, your mortgage insurance is going to be a lot less if you use an FHA mortgage. FHA splits it into, I don't know if I have a, anyway, we'll just go over here. So FHA mortgage insurance, is it PMI? Private mortgage insurance is PMI. FHA isn't giving you the actual mortgage. They're insuring the mortgage, right? So it's not a federal loan, it's a federally insured loan. So the mortgage insurance itself is coming from FHA. So FHA splits their mortgage insurance, or MI, into what's called upfront MI, and they call it annual, but we pay it monthly. Why do they do that? One, they want some money up front. So we finance this upfront premium. This is financed into your loan amount. So have you ever seen a closing disclosure that had a real funky number for their loan? Like 358, 942 is their loan amount. And you're like, that's weird. Why would it be that? Well, they're putting 3.5% down to get an FHA loan, and then we're adding, this is 1.75% of the loan amount, and they add it back on. So they allow you to finance that. Well, that money gets financed by whatever lender you're using, right? The bank. That 1.75 gets shipped off to FHA to put in their coffers in case there are defaults, right? That FHA or that mortgage insurance is in place to help the lender if there's a default. So this 1.75%, a lot of people forget about it, but it gets financed into your loan. So we got to keep that in mind as well. And this annual is either 0.85 or 0.8, depending on, I think my next slide here, if I did it right. And this annual is paid monthly. So we go back to that 680 example, right? On a credit score, 680 on a conventional loan with like 5% down, you might have 1.2 or 1.9 to 1.2% on a premium for your mortgage insurance. So this will be less on your monthly mortgage payment, but you're adding 1.75 on. So we look at all of that to figure out what's going to be the best for them individually. So when I say 680, it's probably closer to 700 now, where we might opt for an FHA loan. Is that helpful for you guys on how that FHA mortgage insurance works? Anything else on the screen? To your point, so FHA mortgage insurance does not fall off of the loan ever, unless you refinance the mortgage, or there are some caveats to that. If you put more than 10% down and it's on there for 11 years, regardless of what you do. If you pay it down aggressively, you're still going to have it on there for 11 years. I think there's a caveat to a 15-year mortgage on there somewhere. Yeah, this bottom part, mortgage term less than or equal to 15 years. 20 years, I don't think I've ever done a 15-year term on an FHA mortgage. So unlikely that they're doing that. But it's still on there for 11 years, and the monthly premiums are a little different as well. Questions on that? Mortgage insurance. VA loans. So these are for our veterans. Typically, we need a credit score of 600 or higher. Have we ever gotten an FHA loan or a VA loan approved under 600? The answer is yes. You need some really strong compensating factors that are getting you an approval on those. There's no down payment required. There is no mortgage insurance, but there is a VA funding fee. So if VA was in here in the room, they probably wouldn't like the fact that I basically described the VA funding fee as an upfront mortgage insurance premium, right? So VA, it's waived if they have any disability. Doesn't have to be a full disability rating. And we would get that information. They would tell us typically that they have a VA disability rating because they were probably receiving income from the VA as well. And or we get what's called a DD-214 and a certificate of eligibility from the veteran or we get it directly from the VA that would show right on there whether or not they have a waiver for that funding fee.
And that's any disability, even if it's 10%.
Yes. Yep. Any rating. So if you get 100% financing, VA loan, first time use, they've never used it before, 2.15 is going to be added to their loan balance. So they'd technically be underwater when they buy the house, right? They're buying it for, what's a good number, 400,000, and they get 2.15% added on there that are 102.15% loan to value to start. Of course, the property might appraise for more or whatever, but essentially, VA loan, awesome loan, great loan. You need to make sure that it's not something like I kind of cautionary with hey, I'm going to be here. I know I'm only going to be on the base at Mountain Home for a year, but I want to buy a house. It's like, okay, well, are you going to sell that house 1 year from now and put zero down and have a funding fee? Well, you might not be able to get out of that house in 1 year if we only have 3 to 5% appreciation on the home. They're going to probably pay you and pay another agent to help them, right? Get the house sold, some closing costs. They may not have the ability to get out of that house without bringing money in. If you repeat, or what we call subsequent use on the VA loan, if you have a house and you have a VA loan and you sell that house, you get what's your eligibility. They call it the eligibility back, and you can go buy another house with another VA loan. But they do charge you a 3.3% funding fee on subsequent use if you're putting less than 5% down. If you're putting 5% or more, kind of most people think 100% financing is VA. Well, our veterans have money, and they may be putting some money down. The best loan out there, 10% down VA, your funding fee is only 1.25%, and you have zero mortgage insurance. So if you are working with veterans, excellent loan, and you need to become familiar with that.
Can they be eligible for more than one property if they can afford it?
So the question was, can they have two VA loans at once? The answer technically is yes. There's a calculation on their eligibility. So really it'll come down to, did they buy a home that was pretty low priced and not use all their eligibility? I don't have a slide to get into the calculation of that. Technically the answer is yes. It doesn't happen all that often. Yeah. Anybody had a listing agent that had a seller that was like, I don't really want to take that VA loan? They have what are called non-allowables. So there are some fees that the veteran is allowed to pay. Allowed to pay regardless of if they pay a 1% origination fee. They can pay up to 1% in an origination fee, which is basically a lender fee. They can pay for an appraisal, title insurance, discount points to buy their interest rate down, well and septic inspections. They can pay for their credit report, CPL or recording fees, so some title fees there, hazard insurance, FedEx, and the VA funding fee. What's the big one that's not on there? Is there ever a chance that a VA buyer would have to pay their real estate agent? So previous to August of last year, they were not allowed to pay any real estate commissions. Yeah. And I'll send these out to you as well. So you'll have the actual slides. This does get asked a lot though. Is that good? The big ones on there, I mean, you don't have all of those every time, but I'll send out those slides. Real estate commission update, and I believe this is still temporary, but they put into a temporary policy that the VA buyer can pay for real estate related commissions. Of course, we need to make sure they have the money to do so, right? If they're putting zero down and you're getting them, some help from the seller to pay some of their closing costs, they may not have that money, but they are allowed now to pay for real estate commissions. So what are called non-allowables, so not always allowed. The caveat on this is they can pay up to 1% in what we call an origination fee. If the lender is not charging a 1% origination fee, they can pay these up to 1%. So you can utilize that 1% for these processing fees, escrow and closing fees, doc prep, underwriting, pest, notary. You can see the whole list there. Second appraisal if VA requires it. So don't get discouraged if you have a VA buyer and you have a seller that says, oh, we won't pay any of their non-allowable fees. We can potentially work into the financing in a way that if we're not charging an origination fee, depending on the price point, all of these other fees might not add up to 1%. They may on the lower price points. They may be more than that. So you just got to keep that in mind.
Is it termite also on that?
Yeah, I think I left that off because it's not common here. Yeah, but yeah, in most states, like on a VA loan, you have to have a termite inspection, but not in Idaho. Yeah, it's just very uncommon here. I don't know. Did I even have it here maybe? I don't remember on the termite because it just doesn't come up in Idaho. They can pay for it, yeah. I don't know if the veteran can or not pay for it. I think the seller might have to pay for that if it's not part of this 1%. So if you're a listing agent on a property, please don't get in your mind that it's going to cost your buyer or your seller more money if you have a VA offer. It might, and it might be awesome if you can cover some of those fees for them. It's a good thing to do. They deserve it. But work with your lender to make sure that you're understanding what the fees are that are not allowed. The two biggest ones typically are those top two, a processing fee that most every single lender will charge, and the escrow or closing fee, right, that the title company. So a lot of times that'll get paid for by the seller in full instead of 50-50. Questions on that? Okay. Is Idaho Housing and Finance Association a mortgage program or are they a lender? Kind of a little bit of a trick question. Feels like because you're marking it on the purchase and sale agreement, IHFA, as a loan program. IHFA is really just another lender, but they allow for things like first-time homebuyer programs, down payment assistance. It's not just for first-time homebuyers. They have programs that you don't have to be a first-time homebuyer, but they do have income limits. So that income limit just went up from $150,000 to $170,000 a couple months ago. So good question. The question was for a single person, $170,000. For some programs, it's household income, but there's some loopholes. So if you have, let's say husband and wife makes $165,000 a year, husband makes $100,000 a year, but you can qualify with just her income and you take the husband off the loan altogether, you may be able to loophole into using an Idaho housing loan. Why would you want to do that? For down payment assistance potentially. Also, they've been pretty aggressive on interest rates. I just sat in on a training today where they're bringing back, has anybody heard of their tax exempt bond program? So what they do, and this isn't always, but they're bringing it back, I think it's March 1, and they sell tax exempt bonds because they're a housing and finance association. They have the ability to sell these tax exempt bonds, which allows them to offer lower interest rates. Those tax exempt bond programs, or the one they have, is for first-time home buyers, unless you're in what's called a targeted county. So there's a whole list of them on their website, or I can help you to get it as well. Targeted counties, just think of the more populated counties. Opposite. A targeted county is one that they want to do more lending in, typically less populated counties. So like Ada County, you have to adhere to the income limits, not the 170, but the income limits for their tax exempt bond program, which are less than the 170. And there's some there's some differences there. So you can't do this, take one borrower off, and you actually have to count household income for anyone that's making income that's going to be on the mortgage. So like a child that's 20 years old that's still living at home and they need that income in order to qualify, you have to count that income, and it's actually a lower income limit than the 170.
Are they eligible if they have a pretty healthy down payment that could just lend that interest down? Or
Yep,
maybe
potentially.
they say, "No, you've got that, no, you don't have it all."
Yeah, no, I mean, yeah, there's some that, yes is the answer. If you still fit into that 170 income and you have a big down payment, we can still look at Idaho housing. So yeah, you might get a more beneficial interest rate by doing that.
The interest rate's so high.
Rates are high. Yeah,
Horrible.
yeah. Do you think I hear that much? Yeah.
I cry about it all the time.
Yeah. You cry? I don't typically cry, but I've just probably I'm a whine about it. I'm maybe a little more hardened to because I hear it. I don't know, 8 hours a day, pretty much. When are your interest rates going to come down? I'm like, man, I don't set where interest rates are, but
It can always be worse.
it could always be worse.
Our first house was
Yeah.
13%.
Yeah,
And we took something that's new fangled. It's called an ARM.
yeah,
And our ARM, we were only gonna get 3 years military. And sure enough, we stayed under, we were at 9% the whole time.
yeah, worked.
Well, you're younger than me. When I bought, they were 18%.
18, yeah.
I'm thrilled to take over a VA loan at 10 and a half.
Yeah.
Absolutely.
Yep, I just answered a text message from a real estate agent. Did rates come down enough to make a difference for this buyer? Not really, was my answer. I mean, they really haven't changed.
If they go up, it's kind of like, you have people all the time, should I wait for the rates to go down, but while you're waiting, house prices are going up. It almost just
Yeah.
seems to be, if you want to buy and you're ready to buy, that shouldn't maybe
Yep.
stop you from buying.
Yeah, I mean, it's pretty easy I mean, some people will just say, well, you're a real estate agent, you're a lender, you're just trying to get me to buy a house, you want to make a commission. No, I mean, just use an example of 2 years ago, right? Well, if you bought a house 2 years ago, rates were pretty much the same, like high sixes. Well, that $400,000 house is probably $450 now, or maybe more. Maybe not quite that much in certain areas. Maybe some have come down a little bit, but the best time to plant a tree, right? 20 years ago. Second best time today. Best time to buy in Treasure Valley or in Idaho, 20 years ago, right? Or longer. Or today, right? I mean, it's kind of hard to fathom, but I mean, home prices, unless we have something catastrophic happen, typically double in about 10 to 12 years. If you look at the history of, values of homes. So, I mean, if you can get in now, the whole, what is it? Date the rate and marry the house and date the rate. Basically you can, potentially refinance in the future. You got to be comfortable in the payment you're getting. Affordability is difficult. But if you can get in now and you can have appreciation help over the next few years, you're going to be better off. I mean, what's the interest rate on your rent? 100%, right? Like, granted, you have to be able to make the payment. So, I mean, I'm making a light of it a little bit, but yeah, it's a challenge for sure. But I would also say there's ways to solve for that. And we have a lot of people right now funding in the next week that are getting rates in the 5s. How are they getting those rates? Mostly with production builders, right? But there are some sellers that are offering, 3% incentive or 5% incentive to buy their house because, a price drop on a home of $25,000. I mean, if you're listing a house at $650,000 and it's not selling, they get pretty antsy after what? A couple hours, but right? 2 weeks and they're like, what the heck is happening? Like, no one's looking at our home and what do we need to do? I mean, that first conversation of dropping it $25,000, they don't like it, but it happens a lot, right? We need to take it from $675 to $650. Well, if you use that same money to give that to a buyer in an interest rate buy down, it changes their payment almost like 3 to 1. Like if you lower it $25,000, their payment may go down, we'll just say $100 a month. If you give them that money to buy their rate down, it might go down as much as $300 a month. Higher price, it's got appraised for that, lots of other things, but we're doing loans at lower rates than market rate at 7% for sure. There's interest rate buy downs, or, you show the math to some people and they're like, well, I would actually rather have 25,000 off the price of the home because I'm putting 40% down and I'm getting the same loan amount either way. And I'll just hope to, it's not a guarantee, but we'll look at refinancing when it makes sense, right? Or I have some that are like, we're only going to be in the house for a couple years, or we're going to sell another property and we're going to pay it off in full. An interest rate buy down feels good, but you're just putting money into something you're not going to have long term. So lots of scenarios there that you need to lean on your lender to be an expert. You have to be really good at what you do to get loans done these days, and to help you guys to help those buyers solve for that affordability. A little bit off track, but definitely important. Okay, what to expect from your lender? What's the biggest gripe that lenders get in general? Maybe not as much anymore, but anybody ever had, this is that's a backhanded compliment. You guys did a great job and I'm so glad I don't have to talk to you anymore. Man, was it really that difficult, right?
My biggest gripe is if they don't talk to me, if they go around me.
Yeah. Communication, right? Consistent communication is so key. And I think for you guys as well, I think one of the challenges that, buyers, sellers, we're talking mainly about buyers today, is they don't really fully, they think they understand, or they don't want to ask a question because they think they should know already. Like, this isn't rocket science, but every conversation you have with them, telling them what's the next step. Don't tell them all the steps. Maybe at the beginning, here's all the steps that are going to happen, but every time you talk to them, the next thing is going to be this, and then the next thing is going to be this. Then they feel comfortable, right? There's some anxiousness in buying and selling homes. If you can tell them what's next and then make sure you communicate and make sure that those things do happen. But from the lending side, I feel like it's important on your offers that your lender is calling the listing agent when your pre-approval letter goes over with your offer. I have some real estate agents that don't like this because they've been burned by maybe a lender that didn't know what they were talking about or gave up too much information. But in general, if you're the listing agent, you get a call from a confident lender that says, yeah, I hope you got my pre-approval letter. I know they sent it over. Do you have any questions on it? These guys are, you can always find something very positive about a buyer. They're very well qualified. We've done our, due diligence. We've gotten them fully pre-approved. Even if they're 640 credit score and they're 49.99 debt to income ratio, we've done our due diligence. We have them fully pre-approved, right? You're just, as a lender, telling them what's in the letter. They should be able to read it, but it gives that listing agent the confidence that the lender has done what they need to do. Pretty easy to get a pre-approval letter these days. You can go online, pretty much plug your information in and hit print to get a pre-approval letter. Click a button, get a mortgage. Heard that one a few years ago, right? From the rocket ship. It's not that easy, but making that call to the listing agent is important. Automation should be giving you guys weekly updates via email. Probably the biggest one I should put a big star on is appraisal updates. It's usually that kind of uneasy, like, did the appraisal get ordered? Is it back? Because there's some timing gap in there. And also explaining that to the buyer, right? There's going to be some dead time. We've done everything we need to. You're fully pre-approved. We're under contract. We don't need anything else from you as a buyer. We're sending all your information in for underwriting. They're like, ooh, that sounds scary. That just means they're going to double check everything that we've already done. And there's going to be probably a week to 10 days here where there's not a lot to update you on. Call me anytime. Same thing with you, right? But that appraisal, as soon as we have it, getting them a copy of it, letting you know if it came in at value. If you ever have a lender that sends out an appraisal that's low to everyone without talking to you, you're working with the wrong lender. If you have a low appraisal, I have 2 right now that came in low, and you have a conversation with the buyer's agent first and foremost, and within like 10 minutes of it coming in, right? Because they need to know, they need to start to have conversations with the listing side to see if there's a a back and forth negotiation there. So appraisal updates. We do a detailed confirmation up front, our processor or client manager, we call her, that sends out, hey, we got RE21, we got the counteroffer 1, counteroffer 2, counteroffer 3, counteroffer 4, and the addendum, but maybe not, exaggerating, right? Just to verify that we have all the documents that are part of the purchase and sale agreement. The price is this, the close date is this, in the confirmation email. So that gives you the ability to say, oh no, you must not have gotten addendum 2 that changed the price from 480 to 478, which is a big deal, or the other way, worse, right, to 482. Have we ever gotten all the way to like the week, we're sending out a closing disclosure and they're like, the purchase price is wrong. Didn't you get addendum 2? So we try to get all that information way up front, right? Because at the end, it's a fire drill. At the beginning, if there's something that's missed, or we just all need to be on the same page. So processor detailed confirmation up front. Review of the closing disclosure. I need a drink. So how many days prior to what we call the consummation or the signing do you have to have a closing disclosure out? 3 days, right? Are there ways around that? Really, no. I mean, the answer is yes. If you have like a true financial emergency, then they can waive that 3 days, but it's very rare that you have one that truly is I'm going out of town and I'm not going to be somewhere I can sign is not a financial emergency. 3 days prior, your lender needs to be getting that closing disclosure out. We call it a pre-closing disclosure because it's not the final one. And that's also where we will do, and your lender should be having I do it via Zoom again, just, hey, let's go over the numbers one more time. You're going to electronically sign this so that it starts that 3-day waiting period. If we send it out and they don't sign it immediately, it doesn't start that waiting period until they've actually signed it, right? So 3 days prior, we'll do a Zoom to go over that closing disclosure. I would try to get yourselves in on that conversation because then if there's any hesitancy. When we get to the final signing, then they should just be excited, right? They shouldn't be worried about what the numbers are. So reviewing the closing disclosure. And a challenge for all of you guys, stop using the word closing. They don't know what it means. What does closing mean to you? Signing. What else does it mean? Funding, right? I would use the terms we're signing and we're funding. Those can be the same day. They aren't the same day a lot of the time. It's hard to not use it because it's right in your purchase and sale agreement. It's all over everything. But when you say we're closing, they usually think that's when they're signing and they get the keys. So be in communication of what that means. We're signing at this time and date and time. We're going to fund the transaction, may just even be later that day. That's when you're actually you are the owner at that time. So have a clear understanding of the signing date and time. Make sure you know their availability. Have you ever had somebody that's out of town when they're buying a house? Happens all the time. Oh, we went on vacation, summertime, a lot. Oh, we're in wherever. Costa Rica. Oh, awesome. Thanks for letting me know. You're going to need to sign some documents before you go, right? So that, we need to know that early on. So be having those conversations. Do you have any vacations coming up? Exciting. Okay, well, we need to make sure that we've got everything done before then. Anybody have questions on any of that? All right, we've got about 10 minutes left, so we'll do some questions or I'll make up some BS up here. Disclaimer again, I know you feel like experts now because we did the class, but you're not experts. Make sure you're using a lender and referring for proper counsel there. Q&A. So we have 10 minutes. You got to stay until 3 so we can just look at each other awkwardly for 10 minutes, or you guys can ask me questions. Question?
What loans are assumable?
Yeah, good question. So the question was, what loans are assumable? FHA and VA. I get the call a lot. Hey, these guys have a conventional loan. I'm gonna call and check and see if it's assumable because their rate's 2.875. It's not going to be assumable.
It's sometimes for family members, isn't it?
It wouldn't really be an assumable loan where they truly get on the mortgage unless you would refinance that. So unless they wouldn't even be selling them the house, basically almost like letting them live there and pay the mortgage payment, right? Are VA loans assumable by anyone? They always have to be qualified, but they don't actually have to be a veteran to assume a VA loan. You typically want them to be. So on a VA loan that is assumable, if it's a veteran that's assuming it, and they would have their eligibility to basically replace the eligibility of the current veteran. If it's a non-veteran that's assuming it, then their eligibility, they don't get it back. So what's an example of why that would work? Somebody that's getting older and they're moving into assisted living and they're not going to need another VA loan, right? That might be a way that a non-veteran could assume it. Just one second, because I might answer this. Is it always a good thing? It's a good marketing piece if you're listing the house, right? You get more people to look at it. But do they get a mortgage for, basically when they assume the mortgage, they only assume the balance on the mortgage, right? So let's rewind. The veteran bought it 5 years ago for $400,000, and you're selling it for how much today? $550, $600, $700,000. Well, their mortgage at the time was 100% financing. They have a $400,000 mortgage 5 years ago. Maybe they've paid down, let's use round numbers, 50 grand. They have 350,000 left, and you're selling it for 700. The new buyer doesn't get a $700,000 VA loan. They get a $350,000 VA loan, and there's a delta between the two that they got to come up with, right? So maybe that veteran sold another house. They have a big down payment. They're putting 50% down, and they want to assume that loan. That's like the perfect scenario. Does the lender that have them pre-approved get them that mortgage? They got to go get approved. They got to qualify with the lender that has the mortgage now. So if you're listing the property, you probably want to get some information if you're going to market the fact that it's an assumable loan, which you should. You want to probably have a conversation with that lender, or have the buyer or the borrower have that conversation with the lender about the terms of that assumability. Are there lenders out there that will make up the difference? I've heard that there are. We don't do a second mortgage that makes up that difference. And just kind of the math here behind that. Just use my hand here, I guess. It's not working out so well. Let's just say they have that $350,000 loan at 2.875, and they've got 20% down. This is $700,000 purchase price. And they get the 350, and they're going to put 20% down on that. It's 140, right? So $140,000 down. So 350 is the delta minus 140 is what? 210? Did I do that right? They need 210,000. Well, even if there is a lender that will give them 210,000 in a second lien position, like a second mortgage or a home equity line of credit, this is probably like 9%, maybe upwards of like 10 to 11% interest rate on that. Well, when you blend this one, it sounds amazing. Everybody wants this golden handcuff rate of 2.875. When you blend it with a big second loan at 9% or 10%, they could probably get a VA loan today at 6.5% for 100% financing. It would be better for them, right? So are there scenarios that work out on a VA assumable loan? For sure. I haven't had one, but I get asked about it a lot. So that was a great question. Thank you. Also, FHA loans, same thing. They're going to have a delta between the two, probably, unless maybe they bought the house a year ago. Well, a year ago, they wouldn't be getting the 2.875. It'd be like 2.5, 3 years ago. Maybe that house isn't selling for much more than they bought it for. Then they might not have a big difference between that. So does that give you enough on assumability of loans? Okay. When's the best time to ask for a referral? I'll weave in another class of mine.
Always.
Anytime. Anytime is probably the right answer, but when you deserve it, I would say. But you got to be asking, right? You got to be asking, do I deserve it? How am I doing? How did we do, right? I think the best time to ask for a referral is after you've said, am I doing a good job for you? And they say, oh man, it's just been an amazing job. Great to be working with you. That door just swings wide open. That's when you can say, well, I'm so glad to hear that. This is a referral-based business. Have your own way of saying it, but referral-based business, and I would love to work with your friends and family that you would refer to me. So please think of me when they're in need as well, right? So when you deserve it, when's the best time to ask that question? Am I doing a good job? When you deserve it.
You've done something.
Yeah. Yeah, I mean, you have to warrant it. I like a midpoint, what I call a midpoint survey. So most people do some sort of ask at the end. Did I do a great job for you? Can you give me a Zillow rating or a Google rating or whatever it is, right? Or you send out a survey, a little Survey Monkey survey, and they fill out a couple questions and you ask them. If they say you didn't do a very good job and you're done with the transaction, you're kind of like, oh, I don't really have much of a time, much time here. You could get them something, you could apologize, whatever it is, but it's kind of like the ship has sailed, right? I had this happen recently, an agent that I've worked with quite a bit, and we send out in the middle. So basically when we get approval with conditions, basically that middle of the transaction is what we call it. We'll send out a little gift basket to the buyer, which kind of helps. Are we doing a good job as well? But if you get the answer, no, man, I don't think I'm getting enough communication, or you have the chance to call them and now course correct for the second half of the transaction, right? So I think in the middle of the transaction, you've done enough to warrant asking the question. Hopefully the answer is 5 stars, everything's great. And you can ask at that point, you're not done yet. Some people like to wait to the end to ask because they want everything to go perfect. But if you're asking in the middle, you can course correct for the end, so you can have a really strong second half and maybe get that referral at the end. If you never ask and they're still like, oh, you're about a 2 or a 3 out of 5, you're not going to get any referrals from them. Is that a good tip as well? What else? Question?
I ask a little, are there like home requirements for like FHA and VA, like the house itself?
Yeah, so the question was, are there home requirements? The answer is yes. So the appraisal, a lot of times, the appraiser is going to be looking at things a little bit more closely, I guess. I would boil it down to really any health and safety issues. Anything that they might not call out on a conventional appraisal. One that has come up a few times in my career is no handrail on the front steps. If there's no handrail, they're going to call it out on a VA loan like every time. If it's more than like one step, because they want to make sure that no one can fall off there. On a conventional loan, you probably won't get called out on that. Can they put something that's pretty temporary up there to get past it? Sure. But health and safety issues, if there's a hole in the roof, a conventional appraiser is going to call that out as well. But yeah, I mean, anything health and safety is typically kind of the thing to think about on FHA or VA. So if you
tell your home inspector, I'm having a FHA or VA loan on this house, a lot of them already know what the requirements are for them to be able to call out stuff to be repaired. And they can put it on the home inspection, they get it fixed before the appraiser has to go out.
Yeah.
But one of the things that caught me on one deal that there was nothing wrong with the house. There was no paint from the shed. And so they made them paint it.
Thank you for bringing that up.
They've come out a couple of times for different pieces of a bit of paint here or there that needed to be done on something that isn't even a building attached.
Yeah, so chipped and peeling paint is a big one. Yeah. You don't think of it as a health and safety issue, but the kids might eat the chipped or peeling paint. And if it's got lead in it, then it's not good, right? well, whatever it has in it, it's probably not good for them to eat it. But yeah, chipped and peeling paint. Oh, that's just it's a garage. It's not even a garage. It's in the north end here, and it's like an old carriage, right? Carriage house. Chipped and peeling paint on that's pretty common. They haven't painted it for 5 years, and the sun's been beating on it. They probably will have to, put a coat of paint on it.
We had to paint a deck.
Deck for sure. Yep. So yeah, health and safety, chipped and peeling paint, railing on the front or on the deck in the back. Those are good things. I don't think I've ever had a fence called out. I guess if it's in disrepair, they might, that it might be an issue. I don't think I've ever had a fence called out.
No broken outlets.
Yeah, I
We
mean,
have a broken outlet place.
They called out, they wanted, so I had a wood fence along the house.
Yeah.
And they wanted a divider in between the wood. Well, that was for termites.
termites. Yeah,
So it was a different.
gotcha.
And I had to put a piece of metal basically in between.
Yeah. A lot of them are, I mean, real estate agents don't just buy and sell real estate, right? Have you ever swept a house or taken your vacuum over there or painted the deck or, like we just got to get this thing closed, right? Clean the house because the cleaners didn't do a very good job or your seller just left. And you're like, oh, I'm going to get a call anyway. Might as well take care of it. But yeah, really good question there, whoever that was. I can't remember.
What about, will they, like, roof line and things like that?
Potentially on the roof. Yeah. I mean, if they're not going to do like a full inspection on the roof, the appraiser, but they're going to look up there where, they may not, they're going to probably get in the crawl space, which they should be doing anyway. But yeah, I mean, I would look at it and say, are there really any health and safety issues here that should be taken care of? Sounds like, your inspectors will be able to help you with that list. It may or may not come up, but I would, caution them that if they're, got a VA buyer that you might have to fix some things. It'll probably come up from a conventional buyer anyway.
If a VA buyer wanted to buy something that was kind of a fixer-upper, I mean, we would be able to, as long as it wasn't a health and safety issue.
Maybe, yeah. The question was fixer upper for VA or FHA loan. I usually just say, well, it depends on how much of a fixer upper it is. If it's, if you've got, the flooring is gone and it's just your subflooring. I've had conventional appraisals that'll go right through and we won't need to do anything with that, but probably going to need carpet down there or some flooring in order for it to get closed. I've had buyers that just, they put in, or they have the seller put in, the cheapest carpet they can, but it's new and it looks good. And
The floor is just kind of in disrepair.
it might get called out. I mean, it's hard to give you a straight answer on that, but yeah. Habitable for sure, right?
Yeah.
Even on a conventional mortgage, I mean, if it's truly not going to be habitable, it's going to be unlikely. And people are like, I get people, I get buyers and agents that are like, oh, if it's conventional loan, we should be just fine. And I'm like, well, there's no kitchen. Like, it's not, the house isn't done, right? They can't move in. There's no working bathroom is a big one, right? Like, yeah, you can use the restroom, but you can't take a shower. That'd be an issue on really any type of mortgage. 303, you guys get extra credit. Thanks for being here.
Thank you.
Yeah, thank you guys.